Hi everyone, and welcome to this week's Video Insight. Well, last week's video on the US bond market flashing red went a bit viral, and investors had a bit to say. Today we're diving just a little deeper into this brewing economic storm: surging US debt, rising bond yields, and a global liquidity slowdown. It's worth working out if things could get a little bumpy. So what's going on? Well, US bond yields, especially the 30-year Treasuries, are near their highest levels since 2007. Why? Investors are getting nervous about America's ballooning debt, now approaching $37 trillion US. There was the 20-year bond auction a couple of weeks ago that revealed softening demand, a huge red flag in itself, and now there's US President Trump's stupidly named tax bill that could add trillions to the deficit over the next decade. As you already know, Moody's isn't waiting around. They've already downgraded the US credit from AAA to AA1, citing the growing burden of financing this debt. If demand for treasuries keeps fading, the US might lose control over bond prices, becoming a price taker rather than a price setter. Meanwhile, it's not just the US. Global liquidity, basically the cash flowing through the world's financial system, is slowing down too. According to Cross-Border Capital, it's now growing at just 3.8% a year, down from 5.5% earlier this year. The Fed, European Central Bank, and the Bank of England are apparently tightening money supply through quantitative tightening. Only China's central bank is injecting cash. This slowdown, combined with soaring US debt and higher yields, is squeezing markets. Interest payments on US debt are reading up 4.6% of that country's GDP, the highest among developed nations. That means higher mortgage and loan rates for US consumers, home borrowers, and businesses. And the Federal Reserve is stuck. Inflation's above their 2% target, and unemployment's at 4.2%, within their full employment range. They just can't fire up quantitative easing like they did in 2008 or 2020 to buy bonds and keep yields low. But if they don't act, rising yields could crush the economy. Think unaffordable mortgages and stalled business growth. So what's the fix investors need? The US needs to get serious about cutting deficit spending and rethink Trump's big ugly bill. It would flood markets with debt at an arguably vulnerable time. The Fed could try limited quantitative easings to stabilise yields without sparking inflation, but it's a tightrope. Globally, central banks have to work together to avoid a liquidity crunch, especially with a big debt refinancing wave coming in 2026. The clock really is ticking. Well, that's all we have time for today. Feel free to share your thoughts, and don't forget to like and subscribe for more updates. You can also follow us on Facebook and X.